Gold is down about 10% year to date. Where do you see the price of gold heading into the end of 2022 and onward into 2023?
A lot's going to depend on just how strong the dollar is, and with the Fed determined to raise interest rates to counter inflation, the dollar's liable to stay strong. So I'm not looking for anything really exciting for gold, but I think we've probably seen the downside somewhere close to that $1,600 level. I would expect to see prices somewhat higher going into the end of this year and certainly getting better through 2023.
Is gold still a safe haven for investors? Because it's not really acting like it.
Yeah, well, people say it's not acting properly as a hedge against inflation. And I think that's simply because this time around, unlike the 1970s, the last time we had serious inflation in this country, this time around the Fed has made it very clear it's going to do whatever it takes, that its mandate to combat inflation is unconditional. So the Fed is clearly determined to do something about it. So it's going to keep raising rates probably too long to push us into recession. And that has hurt gold and could continue to hurt gold going down the road. But as I say, I'm looking for recovery toward the end of this year and into next.
In terms of an investor's asset allocation, what percentage should gold be?
Well, there's no one right answer because there's no one kind of investor, right? At my age, I have a very different liquidity tolerance from somebody who's 25, for example, and a different risk needs, risk tolerances, risk needs, everything. The literature basically says that somewhere between 2 and 10% can probably help any properly balanced investment portfolio. I like personally having a 5% strategic allocation. I rebalance that every quarter, and I have a 0 to 15% tactical overlay that I play with depending on the seat of my pants.
But would you put something like silver in that hard metal allocation? Because silver's down twice as much as gold this year. Or maybe even Bitcoin, which has also been beaten down.
I think there are radical differences between gold and silver that aren't always appreciated by investors in this country. Silver is consumed almost entirely in industrial applications. There's relatively little investment, and there's no central bank buying. Central bank buying has been very important for gold for more than a decade now. Jewelry is very important. It's not that important in silver. I think that the levels of GDP growth in the United States in particular are going to be determining the level of the silver price, and I'm not optimistic about levels of GDP growth looking forward.
And what about Bitcoin?
Bitcoin, I think that any asset class that lost 2/3 of its value, that went from $3 trillion down to $1 trillion in a matter of a few weeks, has lost any claim what it may have had to be a strategic asset. It's just another risk asset, along with many, many other risk assets. It can be fun as a punt, but it's a roller coaster ride. You better be prepared.
And if you are worried about the state of the world, whether it be Ukraine or Taiwan, you might want to own gold, but why own it in the form of an ETF as opposed to getting some bullion and putting it in a safety deposit box for when that day hits?
Greg, I think you've heard me say this many, many times. There's no wrong way to get exposure to movements in the gold price. But I think that since we launched GLD back in 2004, investors have voted with their wallets and their pocketbooks, and I think they've made it very clear that they like the liquidity, they like the ease of transacting that you get with an ETF. You don't get that if you own physical bullion and then take ownership and take it home. You have all of that ease of ownership. Basically, we took the friction out of investing in gold when we launched GLD, and I think investors appreciate that.
And then finally, there's the GLD and there's the GLD minis. Can you just explain the difference between the two?
Sure. A few years ago, we became conscious that across the whole universe of ETFs, not just gold ETFs, there was a trend towards A, lower share prices, and B, lower expense ratios because of the fiduciary responsibilities that people were increasingly becoming aware of. So we launched GLD Mini. It's essentially the same as GLD. It's 100% backed by physical gold bars stored in a vault. It's just that it's based on 1/50th of an ounce of gold rather than 1/10th of an ounce of gold, which is what GLD was based at on inception. GLD, because it's been there longer, has developed enormous liquidity and therefore trades about a penny wide between bid and ask. GLDM is a much, much broader spread, but the lower expense ratio is designed for the buy and hold investor. GLD remains the preeminent vehicle for anybody who wants to rebalance on a regular basis, for anybody who appreciates the low entry and exit costs. Also, GLD has developed a really deep and liquid options market. None of the other gold ETFs have that. That's a big plus for GLD too.
All right, well, thanks a lot for coming on and talking about it.
Thanks, Greg.